We didn't want to be corporate. We didn't want to have this sense of treating people poorly. We wanted to treat our people with respect, which is one of our values. We wanted to ensure that we operated with the highest level of integrity. And, every decision we make and have made subsequently has been put through that prism of those values. And I think it's held us in really good stead.
Welcome to the Domenic podcast, where I interview business people who run or have sold businesses worth a few $1 million all the way through to billions of dollars. While most of my time is spent managing investment portfolios for people after they've had a successful exit, I've always been fascinated by the entire process and hearing the insights that successful entrepreneurs and business people have learned along their journey. At Fortress Family Office, we're an investment portfolio manager and we manage portfolios for ultra high net worth families. If you'd like to know more about not only the way we approach investment markets, but our philosophy on life and business, feel free to subscribe to my weekly insights note. Go to www.fortressfamilyoffice.com and hit subscribe. In this episode, I interview Domenic Lo Surdo, the founder of Stamford Capital. Stamford Capital provides property developers and investors with access to a broad range of financing options and advice to ensure their transaction is successful. Founded in 2011, Dominic grew the business in the aftermath of the GFC into a successful provider of finance amounting to billions of dollars in transactions per year. Throughout the episode, Dominic talks about the importance of understanding yourself to be an effective leader, as well as the importance of company culture. I hope you enjoy the show. Feel free to leave a review and share with your family and friends. Dom, welcome to the show. Thanks for joining us.
Pleasure to be with you, Dale.
Do you want to start by just giving us a little bit of background about how you got into the industry and why you got into business in general, before we go on to a little bit more about your current business and what you do there?
Yeah, sure. No problems. Always been interested in business, always been interested in finance. My father was an accountant and he had a few businesses which he ran outside of the accounting practice, which he'd invested in. And we invariably got involved in those businesses, especially on school holidays when he was asking us to do stuff like clean up the factories and work from a pretty young age, actually. So we've always been working from a very young age. And so I don't know, business is kind of in the DNA as a consequence of me being surrounded by, as a young man, being surrounded by dad and what he was doing in business and what he was doing specifically with his accounting practice. So I always, even as a young man, interested in the stock market and always interested in and studied, economics and commerce, et cetera, at school. And so when it came time to matriculate, it was a pretty obvious choice for me to study a commerce degree. I did flirt with sort of commerce law. I was accepted to do business law at UTS, but thankfully didn't go down the law path. I don't think I would have been very good at it in any event. So yeah, made the decision to go down the pathway of studying commerce. And I guess from there, careers evolved subsequently.
Were you one of those kids that started a business when you were in your teens and doing those sorts of things, or not so much that side of things because you had your dad's businesses that you were sort of already preoccupied with in school holidays?
I wasn't entrepreneurial in that sense. I think I always worked hard and dad instilled those values in myself and my brothers. I'm pretty risk averse, Frank, which is an unusual thing to say for someone who started a business. And I'm sure we'll get to this later on in the discussion, but you do a commerce degree and it's such a broad degree.
Yeah.
You can almost end up anywhere, right? It's not like one of those degrees where you end up, basically studying what you're going to become. And so even post graduation, I still wasn't really sure what I wanted to do and actually went down the accounting pathway first. Much to dad's disappointment, I didn't like accounting. So I decided not to take over the accounting practice, which he was pretty graceful about, I have to say. But then subsequently went down the finance route and just started working in corporate Australia. So whilst I had business and a really good work ethic in my DNA, it wasn't until much later where I guess the entrepreneurial spirit really came to the fore. I was in my mid-30s when I started my first business. So I'm probably a little unusual in that context.
The business that you've got now, which is Stamford Capital.
Yeah.
When did you start that business?
Yeah, so Stamford's 12 years old now. I was 35 when we started the business. We started the business in 2010, so just as we were coming out of the GFC,
Okay.
which sounds like a dumb time to start a business, especially in financial services. But in fact, it was probably the best time to start it, just given flux in markets and
Yeah.
difficulty in finding capital. And to be honest, I don't know, my hand was forced a little bit in that the previous business I was working at went through some pretty tough challenges, and I stayed with them through those challenges on the promise that I was going to get some equity in that business, and it never materialized. And
Yeah.
so I
That
thought,
old trick. You're talking that post GFC phase as well, which was a scary time for everyone, especially in finance, because even from like that 2007 through 2009, and in 2009, share market started to recover pretty strongly, but the world was still very uncertain in terms of where does everything go next, right? It was a very, very uncertain time. So to be able to even step back from all of that and look at things with fresh eyes probably would have been a great thing to be able to do.
it was invaluable. And look, it changed the course of my life, frankly. The easier option would have been just to take a job with somebody,
Yeah.
and a well-paid job,
Yeah.
And I think often people who are caught up in the corporate world default to that because it's a comfort. It's a comfort position to take, and it's an easier position to take, frankly, because it's not easy starting a business. I can assure you, it was a great time in my life where I was able to recalibrate, as I said, and sort of take a little bit of control over my life. I think that was the one thing which, prior to that point, whilst I was working for people and I felt like I had a sense of control, the reality was you were always beholden to
Yeah.
someone else's rules and someone else's values and someone else's, view on strategy and markets. And I kind of just wanted to have a crack on my own. So yeah, that's what led to Stamford being born, I suppose.
And in terms of the business and coming out of that GFC, which, like you say, it sounds like a tricky time to do it, but in terms of your business, where you're funding property purchases and those types of things, right, where the banks were at that point retreating from a whole range of different funding. So I imagine that, and that was because they were just battening down the hatches from their perspective and cleaning everything up. But there was a big void there from memory around, which I presume was the opportunity that you guys were able to identify and take advantage of since then.
Yes.
Because the banks moved out of it and there was a big demand for that type of finance that the banks just didn't want to have a part of, which was kind of foolish, but they were just doing their McDonald's cookie cutter business model and didn't really assess risk. That was my understanding of how they reacted, and a whole range of property investors couldn't finance their purchases that were actually good purchases still.
Yeah. Listen, credit definitely tightened when there was a liquidity crisis, which is obviously well published. Interestingly, there was, if you sort of separate the credit markets into bank and non-bank broadly, there was a non-bank market pre-GFC, but it actually got decimated as a consequence of the GFC.
Yeah.
And principally because the federal government decided to guarantee bank deposits. And so there was a run on non-bank capital. I mean, anyone who had money and exposures to these non-bank lenders at that point in time decided that they wanted to get their money out. And of course, you're funding, your liabilities are funded short and your assets funded long from a lending perspective. And all of a sudden, all your investors want their money back. Well, it's a problem. So that effectively, redemptions were frozen, and that effectively decimated the non-bank sector. That was 2007, 2008, and probably continued for a little while. So when 2010 came around, it was pretty interesting in that there was still this lack of liquidity in markets. But we were very fortunate at that time. We picked up a mandate from a fund out of Singapore, and they were wanting to do first mortgage finance in Australian construction space. And that gave us the capacity to write, a couple $100 million worth of deals in our first, 18 months of starting the business. And it really put us in a good position to be able to then scale the business from there. And you're right, the dynamic then evolved over that, call it 10, 12-year period since the GFC, where the non-bank sector has definitely come back at strength and is continuing to play in segments of the market where the banks are just unable to play, either through policy decisions or regulations that are being forced upon them through the regulators such as APRA. So, and if you benchmark Australian markets relative to the US, UK markets, there's still a long, long way to go in terms of potential growth in the non-bank sector. And Stamford's obviously very active in facilitating transactional flow between borrowers or needers of capital in the real estate space and those that have capital and wanting to find deals. That's what we do at our core. But yeah, I guess we've been a beneficiary of that, that growth.
How's the business grown, Dom, over that time from when you started? We started from scratch back in 2010,
yeah, it's amazing actually. Like I often reflect on things going, how did that happen? But we started the business really with a set of what we then called principles, which have evolved to be what we call our values now. And they haven't changed. So when we wrote our very first business plan, Michael and I, which we never actually finished, we only got about 3/4 of the way through, and then we actually started the business. So maybe there's something in that for new entrepreneurs. Sometimes you just got to get on with it.
Get on with it, yeah.
So, and it's still not finished, that original business plan, but I think we did start with a set of principles which we've held ourselves to through that entire 12-year journey. And those principles are well understood, or values are well understood by not just the shareholders, but the executive team and the entire staff. So, and the entire team, including, it's the first thing I talk about when we have new starters in the business.
Yeah.
So that's really important. And I must say, we didn't call them values when we started them, but it was almost from a negative that we started them. We didn't want to be corporate. We didn't want to have this sense of treating people poorly. We wanted to treat our people with respect, which is one of our values. We wanted to ensure that we operated with the highest level of integrity, which is again one of our values. And every decision we make and have made subsequently has been put through that prism of those values, and I think it's held us in really good stead. But when we started the business, it was hard. Like the reality was, we had 3 of us at the time. We had no balance sheet. We had no clients. We were running on the smell of an oily rag. I mean, I'd sublet a space from a mate of mine who was a lawyer down at Goldfields House, which I'll be eternally thankful for, because I think he did me a very favourable deal to give me some space. But it was really challenging. We had no brand. We had no presence in market. And so starting from fresh with that, with that context was really challenging. But what we realized we had to do was to just write some revenue. So we spent the better part of the first 12, 18 months really just pounding the pavement, going to see clients, selling our wares, so to speak. And that's all we did. We didn't even think about strategy. We didn't think about growing the team. We didn't think about, I guess, what most businesses would do when they're starting a business in terms of forward planning. We did have some aspirations around having a brokerage business, which, we've touched on to date mostly, but also a balance sheet, which we've now built out and sort of built out over the last 8 years or so. And that was always part of the original business plan. So we had this, we had this sort of guiding light without necessarily having a pathway on how we're going to get there. But we had to run really hard, because if we didn't succeed in that first 18 months, then we would have been back in corporate world. And I hated that world. I hated that part of corporate Australia. And that was a real driving force for both Michael and I when we started the business, was we just don't want to go back there. Like it was something that, ironically drove us. It wasn't about building a successful enterprise, even in the early days. It was just about not wanting to go back and work for shitty businesses anymore. Like it's just not what we wanted to do.
But that need for independence and being able to be autonomous and live your life how you want to live. It's not just business. It's around about how you're living your life. And like you say, the values that you want to live, that goes through to your business. And so if you want to do that, then, operating your own business is the only way to really achieve that. Otherwise you're going to be, like you say, beholden to somebody else's ideas. And tough to get away from.
Yeah, no, that's exactly right. And I think, the business for us, I mean, it's grown significantly. I mean, we last year settled $2.2 billion worth of settlements. We're the largest commercial mortgage origination business in the country.
How much was that, Dom? 2.2 billion.
2.2 billion. Yeah.
Yeah.
We've got offices now, Sydney, Melbourne, Brisbane, Adelaide. The exciting thing for us is we still feel like we're at the front end of a journey. So there's so much potential and growth opportunity in the space that we're in. And I think, to some of the comments you were making earlier around the banks, they were tightening up and continue to operate, in a constrained environment. And, the old school relationship manager, which good clients used to be able to rely upon, just doesn't exist in the banking sector anymore. And we feel like we've replaced that relationship manager role. We act on behalf of our clients. We act in their best interests. We perform an agency role, obviously, in that brokerage business, in that originations business. But the best thing about our business, we aren't a bank. And so we've got the whole plethora of product offering, which is available to our clients, which ultimately means we can solve for whatever situation a client has. So the more you're seeing in terms of flow at the front end, the better place you are for pricing for risk, particularly in this environment that we're going into. I think that is particularly true. Yeah.
Yeah. And in terms of that, how do you see this sort of market evolving? Because it's a tricky time, right? Like in terms of, if you look at what's even happening in the bond market over in Europe and the UK, how do you navigate sort of such uncertain times as what we're seeing and probably have coming ahead as well?
Yeah. It's a really good question. And it's absolutely true. I think there's this, the real estate markets unwind really slowly. So, unlike the equity markets, which unwind overnight, and literally overnight in some instances, the real estate markets can take 2 years, and that's partially due to the fact that the credit markets and credit facilities that are put in place tend to be for, in Australia at least, sort of 2 to 3 year periods. So whilst those facilities remain on foot and there isn't sort of revaluation events or covenant breaches being reported, there's no urgency for things to happen.
Yeah.
But there is invariably going to be an unwind. And look, the equity markets, if you believe them, the equity markets in the REIT sector are off 30 to 35% in terms of what they think is going to happen in the underlying real estate sector. And the real estate market hasn't really adjusted yet, not the commercial real estate market. We're obviously starting to see, the home loan market come back, specifically land and housing, not necessarily apartments. And there is a distinction there in my view. But the commercial markets haven't really shown any signs of softness or deterioration, but we do think naturally it has to come. I mean, you can't have assets trading on, 4% yields or 4% cap rates and borrowings at 5%. I mean, that can only, hold true for a period of time before people say, hang on, we probably need to reevaluate what we're paying for assets or what we're valuing assets for. So again, I think as a business, we're in a pretty unique position to be able to withstand that storm, and we're certainly well capitalized. And, as credit markets get tighter, the value proposition in our business just increases so far as we can find pockets of capital that can solve for clients' particular scenarios. And then on the balance sheet side of things, obviously, as we go through this correction, I suppose is the right term to use, we will probably find better value in terms of, being able to identify a risk premium or a return premium relative to risk. I think markets have been repricing risk or been pricing risk incorrectly for a couple of years, just with the weight of liquidity. I think so. Price is one thing, and I think markets will adjust to price. That's for me, and people will get hurt. And I don't want to sound dismissive of that. I think the reality is that some people will get hurt, and that's, it's unfortunate, but we are in
it's the market, right?
We're in a market economy, and that's what happens. And so people should be cautious, and we are cautious around certainly where we're deploying capital
Yeah.
in this market. As Michael, my business partner, says, we're just trying to avoid potholes.
Yeah.
But at the same time, the bigger question is around liquidity. And so, what drove the real correction in underlying real estate markets through the GFC was a liquidity crisis. Because when capital stops flowing and people are forced to sell assets, then assets adjust in value pretty quickly, to the negative. And so we're monitoring liquidity pretty carefully.
It's a really unique situation that markets don't, almost in denial in terms of, like, if you look at where the US Fed and some of the other central banks are with interest rates, gone from basically 0% in interest on from the Federal Reserve up to, basically going to be at 3%. And everyone was sort of adjusting to that. That's where your share market had that discount down 20%, really, on the back of that adjustment for the asset valuation. But now it's looking more and more like you're going to go through 4 and maybe head towards 5.
Yeah.
And I think that's realistic. I think everyone is everyone's in denial until it can't be denied any longer. And equity markets are very slow on the uptake. As much as they do react overnight, sometimes you have these mini rallies along the way, and we've seen that sort of first 6 months down 20% in the US to June, about middle of June, and then for some reason everyone decided that we should have a rally and was up, a good 10% or more, and it shouldn't have been because nothing changed, and the Federal Reserve was going to be hawkish. They came out and were more hawkish, and then markets have dropped back down to that level again. And from here, it just looks like rates are going to go higher. And so share markets are struggling with that still. And I think there's more pain to come in share markets for that reason. And presumably that flows through to all markets and all asset values and risk assets at some point. So
one of the fundamental learnings I've got from a commerce degree is everything's priced off the long-term cash rate or bond rate, right? So, which is risk-free. So, notionally risk-free.
Yeah, notionally.
So you're probably right. And look, I'm no expert on the equities markets and don't pretend to be. I mean, I understand real estate, in a deep way. And by virtue of that, I don't have any equities exposure at all personally. But to your point, asset prices broadly have to correct. I mean, it's just inevitable. Over what time frame and how deeply, I think no one really knows. I mean, everyone's hypothesizing, right, as to how high rates are going to go and what it actually means. Do we actually find ourselves in a recession? But the reality is no one really knows, because it's a pretty unusual environment that we find ourselves in. It's a
really unusual. Yeah.
Very, very unique in the context of the amount of liquidity in particular that's been pumped into markets. And now, not only are rates going up, but you've got quantitative tightening going on across all the market economies, which is also fueling, that tightening in credit conditions and tightening in liquidity. So we'll see. We'll see. There's certainly some headwinds in markets, and being consciously aware of that is something that we're certainly talking about in terms of.
Yeah. And in terms of your business, are you taking a more cautious approach than what you might have been 12 months, 2 years ago in terms of the way you look at deals? Are you assessing them differently, or you've always assessed them with the same prism of risk, knowing that things can change and you need to be protected ahead of the deal being done?
Yeah, we're high conviction investors, so on the investment side of our business. And we tend to play in the mezzanine equity space so as to not have a conflict with our debt origination business.
Yeah.
And as a consequence of that, we, when we're underwriting a deal, we're leading to the due diligence, sponsor, asset, other risks that might be associated with a particular transaction. And that includes what's happening in the macroeconomic sense. So, and look, it's where markets are relatively stable, that's one risk which you can take a fairly, confident view on. I think as markets become a little bit more volatile, you just have to be cautious around that view and ensure that you're building in space for that volatility in terms of how you're structuring transactions, how you're pricing for risk, and ultimately that you're backing, the right sponsors and the right assets, the right asset classes. So look, we've been very successful with that to date. I mean, I learned a lot from my previous role, having to clean up a $150 million book in terms of where assets can go wrong and why they go wrong. And
Sort of post GFC sort of consequences.
yeah,
Yeah.
in the job I was working in before I started Stanford. So that was as I said earlier in the podcast, it was definitely it was a great learning experience, as painful as it was.
Yeah.
And I think probably still influences the way we make decisions in terms of investment decisions now, because
Yeah.
that pain, that scarring is still raw 12 years later.
Yeah. Do you see any similarities in how things are? I know it's different because you don't have the same sort of subprime type situation from a debt point of view, but I look at it and I started my business in 2007. So right
Right.
at the gym, which made things quite difficult, obviously. But I can see some similarities in terms of the building pressures compared to 2007, and where everything is going the wrong way in a macro sense, a geopolitical sense. Everything is pointing in the wrong direction. So I can see some similarities, that 2007 situation where nothing catastrophic's really happened yet, but you can see the potential for any one of about half a dozen things to go the wrong way. And you're
Yeah,
starting to see some of those. Do you see any of those sort of similarities, or not so much in the property side of things?
look, every cycle is slightly different, right? And what triggers those corrections invariably is different every time round as well. But I don't know, I've been through a couple of cycles now, and I guess invariably markets swing too far in both
Yep.
directions.
Both ways. Yep.
So in terms of similarities, yeah, I guess I can. We definitely saw, and I guess, as I said earlier, we're starting to see sort of credit conditions tighten, and not materially, but we're certainly seeing, just off the back of how quickly
Yeah.
cash rates have risen, the fact that some sponsors that are geared are going to have to find solutions for, potential covenant breaches on their lending facility. And that feels very, very much like 2008. I don't think we're going to see, and I certainly hope we don't see, the wholesale collapse of the global financial system, because hopefully markets have learned from that. And there's nothing that's, indicating to me that is going to be the case.
Yeah.
But, I am concerned that the amount of money that's gone into markets over the last 2 or 3 years to deal with the response to the pandemic. And listen, I think by all accounts, that was done well, by
Yeah.
federal government around the world, because we had a once in 100-year event that needed to be managed. But I also think, speaking very broadly here, monetary policy probably went too far
Yeah.
in terms of the easing of interest rates, cash rates. Probably the level of quantitative easing that's happened globally probably went too far, as I said. And so we're now paying, the price for that. And I'm not a commentator on monetary policy, but I'll leave that for others. But that's my view. I think the other thing is that governments around the world just don't have the intestinal fortitude to deal with fiscal policy properly. And I've made comments in social media around that over the last couple of weeks. I mean, we need genuine tax reform in this country.
There's no long-term thinking, right? And that goes across the board, where governments basically pander to the consumer and to the general population, because no one wants to go through any sort of economic pain. But sometimes a little bit along the way might not have hurt so much if it meant we got things in better order. Instead, they just keep bringing the checkbook out to make things better, and it doesn't really help. And it's happened across the world. It's not just our government. It's every government that's done it. But it's put the world in a precarious position in some respects, because you've got to keep funding those deficits from somewhere. And as borrowing costs go up, that becomes a problem, right?
Yeah, it becomes an increasingly challenging problem to deal with, right? Now, I think the response out of the equity markets, and particularly in the US, and I do think the Australian market is different, by the way. I think there's a lot of positives around the Australian economy relative to the global economy. But, there was that short-term rally that you talked about. I think the equity markets in the US have gotten so used to, the Fed protecting equity values.
Yeah, the Fed put, they call it.
They think that's going to continue forever. But the rhetoric coming out of the Fed over the last couple of months is like, guys, this ain't happening anymore. And I think that's where we're starting to see, more bearish consequences coming out of their markets. So anyway.
Yeah, it's like the kid with the hand in the cookie jar. They just they keep putting the hand in and nothing happened, and they kept doing it. Now they don't believe them, and so now they're getting a real whack. And it's taken a little while for them to understand that they can't go back again. So that's what
they've put their hands in the cookie jar so often. There's no cookies left, mate.
Yeah, exactly right. That's exactly right. And like, going back to the business in terms of when you started, what was your biggest strength when you were sort of that first 12, 18 months pounding the pavement, as you said? What was your biggest strength as a leader in the business to help you succeed as you went along?
Oh, listen, I think it's funny, like I reckon for the first 5 years of our business, we didn't really have a business. We had a bunch of guys doing deals, and it's a big distinction. Like I do think, and we could talk about this later in the podcast, but it was just, we were just surviving. Like that's frankly really what it was about, and building up, very slowly and organically. And we had some wins and we had some horrible losses, and I think resilience is really important. I mean, one of the things that you have to have when you're starting a business is the ability to be able to pick yourself up off the canvas when you don't win a big contract, or you don't win a deal that you thought you're going to win, or something adverse happens, because invariably you're going to have those challenges. I mean, every business is going to have those challenges, particularly in the early days where you're just trying to establish yourself and you haven't got the benefit of an established customer base and, an established income, which you can, semi-rely upon, or revenue that you can semi-rely upon. So I think from my perspective, having resilience was really important. I think the other thing for me, I was very fortunate to have business partners, which, whilst I might have been having a shitty day, the other guys were positive and would pick me up. And you talk about, some of the VC firms in the US will only back founders where the business has two partners, and I get that. And I think that's, the thought of starting the business by myself, I just don't think the business would be anywhere near as successful as what it is today. And question, frankly, whether or not I could have personally, individually, gotten through that first couple of years of pain without the support of shareholders and partners. I don't know if they'd say the same thing about me, but I hope they would.
Yeah, but amazing. Was there a time, Dom, where you got to a certain point where you went, we are on the right track? As you go along, you say that first 5 years, even you were doing deals, but was there a certain point over that 12 years where you've looked at it and gone, hang on, we've got a serious business?
Yeah, there was. And I think what happened was, for us, we started making some money, we started doing some really good deals, we started building great relationships with clients, as I touched on earlier, that relationship management piece, and repeat business with those customers. And, we could see that markets were moving, in our favor in terms of the availability of capital, and particularly in that non-bank space. But we've always maintained terrific relationships with both the bank and the non-bank sector, because many of our clients go to the banking sector and just use us to facilitate outcomes. But we got to a point probably 5 years into the business where I realized we just needed some help, because we didn't know what we didn't know. And so through our accountant, we brought in someone just to review our business. And we knew what we had was working, in the sense that we had this great base, like there was a great level of energy and synergy with the shareholder. And that sense of values, those core values that I talked about, principles that we called them initially, were working well for us. And we were able to then start attracting some people and staff to the team. But we were still really operating as a cooperative of people doing deals. And I knew at that juncture, at year 5, we needed something more. I knew that we needed, if we wanted to make this thing a business, we needed to put in place something. And so I didn't know what that something was, frankly, because I'd never started a business before or ran a business. So we had a consultant come in and went through this process, which was super interesting. He basically separated the 3 shareholders at that juncture, and we weren't allowed to speak to each other. And asked us questions individually, like, where do you want the business to be? Where do you want to be personally? Do you want to keep working? Do you want to sell the business? Do you want to keep building it? Questions like, do you like working here? Do you like your shareholders? And I must say, I thought they were pretty silly questions, some of them, because if you didn't like your shareholders, why would you be in business with them? But we fellow shareholders. But the reality is, as he explained to us later, there's businesses out there that, where there's that conflict
Yeah.
un,
Yep.
unresolved. And
Yep.
part of the process that he went through was to identify if there was an alignment, between the shareholders. And anyway, we went through this process, and he looked at our originations business and he looked at our investments business at that time, which were, obviously starting to grow. And he said, well, he challenged us and he said, well, with this originations business, why don't you franchise it? And I'm like, what are you talking about? That thought had never entered our minds before.
Yeah.
And then what he did was really interesting. He said, well, your originations business is worth this and your investments business is worth this, probably there or thereabouts. Well, we never even thought what the business might be worth to that point. And it was that point in time, that
Yep.
process went through. His name was Mark. With Mark was pivotal, frankly, in
Yeah. Okay.
driving the success of the business, because what he then did was we then worked out, we had this great alignment, we had this great synergy at shareholder level. We're all pretty young guys, young families who wanted to grow the business. There was no sense that anyone wanted to exit or sell or any of that stuff. So, and that's still the case today. So I think what it allowed us to do then was to make some decisions around actually creating a business, so we put in place, for instance, we hired subsequently a chief operating officer, chief financial officer, a group head of marketing and communications, and we hired a head of investments, which runs the investment side of the business now. And we put in place all of that process and infrastructure and built out strategic plans and, which we hold ourselves accountable to, and it really transformed the business. And that's been a journey in and of itself over the subsequent 7 years. But
Yep.
I do honestly believe if we hadn't gone through that process and made those decisions at the time that we did 7 years ago, we'd still be a bunch of guys doing deals and
Yep.
probably be 3 or 4 people, because part of what we then learned was, the value of a brand
Yeah. Okay.
and the importance of ensuring that we build out and hire great people, and not just in those core, I hate to use the word because it's, very corporate, but that sort of C-suite
Yeah.
roles,
Yeah. Yeah.
and really smart people in those roles that are, just bring a whole different way of thinking and ideas to the business, which as operators, Michael, David and I, who are transactors or have been transactors in the past, and Michael and Dave continue to transact, by the way. I was the one that was, I guess, chosen to come off the tools. And
Yeah.
that was another decision, sorry, that had to be made when we did that review. Mark said, well, one of you has to run the business because
Yeah.
you all can't just be doing deals. And if none of you want to run, you need to hire somebody to run the business. And to be honest, I was probably tiring of the transactional side of things at that juncture. So I as much as I say the guys, I ended up running it. It was a choice which I wanted to make. And the guys, Mike and David, I'll be eternally grateful for, because or grateful to, because it allowed me to then go down this other journey, which is around leadership and running a business and strategy and operations, which up until that point I didn't really have any experience in at all.
As you moved into that leadership role, what was your biggest weakness as you sort of tried to adapt from, well, I say adapt, but as you took on more of that running the business, and how did you address that as you progressed?
Yeah, it's a really good question. I think for me, I reckon doubt is a bit of a superpower of mine. So
Cool.
I'm often doubtful about things, which then means when it comes to making decisions, I'm somewhat slow and considered, but at the same time, I challenge the assumptions. And I think for for me personally, having that element of doubt allows me to probably make better decisions insofar as when you're making the decisions, I'm arming myself with a bunch of facts, data, and opinions from a bunch of people which help form that decision.
Yeah.
I think in terms of, weakness, I guess having not run a business before, I didn't think strategically enough. And frankly, I think the business probably could be further down the road than it is today if we thought more strategically earlier on. I think if we'd invested in going through that process with
Yeah.
Mark
Okay.
a couple of years earlier, and the reality was we might not have been ready, maybe we weren't, but just being mindful of what I now know and drawing upon an expert is something that I think would have been beneficial to the business if we'd started earlier. But, listen, you can't turn time back, and you
No.
make decisions in the context of the environment you're in, rightly or wrongly, and you got to live
Part of the
by that.
journey too, right? It's part of your learning, and everyone learns these things at different rates, some faster, some slower. And, those lessons, they're just part of the journey. You can't do without it. And including sometimes when you think you could have done it quicker, there might have been something else you missed out on along the way that you'd never know. So,
Yeah, yeah, and it is interesting to start a new business. I talk about these. I talk about having this, chasing bright, shiny things. So, we'd have number of people would approach us and say, "Oh, can we invest in the business? Can we, do you want to partner? Do you want to bring capital?" And we'd often get swayed into having those discussions with those parties where it was distracting, and
yeah, okay, yep,
invariably nothing happened or nothing eventuated because we weren't ready. And if we'd had a very clear strategic roadmap, we would have been it would have been easy to say no to those
yeah,
things.
yeah, yep, yep,
And I think, if I think about the business now, it's actually really easy making decisions because we've got a very clearly articulated strategic plan. And look, that might change tactically given the environment we're in, but we're on this pathway that not only do the shareholders understand, but the executive team understands, and the new employee who's been here a week, he understands or she understands it as well. And so having that clarity of strategic direction allows us as a business now to be able to make not only better decisions, but to be able to say no to those bright, shiny
yeah,
things
yeah,
from time to time. And you know, it's taken me 12 years to work that out. Yeah. Like
yeah.
it wasn't something that became apparent to me. And even developing that strategic plan, like that doesn't happen overnight either. The reality is that changes, it changes over time, it changes as the business grows. And you're not resetting your strategic plan every 6 months, obviously, but and you do want to think that it can hold through a medium term cycle. But the reality is having that clarity, I think, is really important. And it's something that I just didn't have. I was naive to early in the growth of the business.
But it's not something you can just click your fingers and have either. That just comes through the trials and tribulations of being in business and working out where you're at, right? I know exactly what you're talking about. And I've had the similar type of thing over a 15-year journey in my business where now I understand what parts I want to do, what things I say no to. And once you rule out most of the stuff, it just makes it so much easier to make decisions around things because you're right. There's so many things you can do, but until you really realize what you want to do and what parts you do well, and you say no to everything else, there's a lot of time that is involved in learning and to get to that process, get to that
Yeah,
part.
yeah, absolutely. I mean, I think the other thing is, coming back to your question around leadership and that growth journey, the one thing I did do after we had that review with Mark was actually formalize some relationships with some mentors, and I joined a group called Tech, the Executive Connection, which allows me once a month to get out of the business and talk to other, CEO, managing directors around what's going on in their world, and just gives me some perspective side of the business. And I think that's been, leadership. I used to think leadership was something you're sort of innately talented at, like born into,
Mm,
but it's just not true. I honestly believe that it's a craft that you need to learn,
yeah,
and part of that learning is around what type of leader you want to be, because you can have different types of leaders equally successful. But the one thing I have learned is you have to be true to yourself. I'm a collaborator. Like I need other people around me. I need to question, that question of doubt. I need answers to questions that I'm continuously asking myself. And I'm not the type of leader to say, yeah, this is where we're going and everyone getting behind me. That's just not my
Yeah.
style. And I had to work that out, and then I had to be accepting of it, because I always felt the most effective leaders were the people that, just took charge.
Oh, okay. Just a stereotype of what you perceive, even just from being young, right?
Yeah. Yeah. And I think, that was really great insight for me over the last 5 or 6 years. Was there's different types of leaders, and not only is there different types, you need to work out as a
Yeah.
leader who you are and what type of leadership style you actually have. Because if you try and be something that you're not, like,
Yeah.
it's just gonna break, like,
Mm.
and not only that, the organization will suffer because you're not true. People will see it, they'll see through the facade, and that's been a real deep learning of mine over the last 5 or 6 years. So,
Yeah, okay.
and again, I think, talking about having strategic alignment, when you've got that personal alignment in your leadership style,
Yeah.
just makes the whole decision making process easier. Like
Yeah.
how you speak to people, how you engage with people, how you conduct yourself in a leadership capacity, how vulnerable you want to be. I think that's really important as a leader to be aware of that. And again, it is a craft. It's not something that this is another big learning for me. It's not you're not born a leader. It's something that comes through trial, tribulation, and insight.
Yeah. And that just comes over time as well. Just
And
actually just by doing, right?
Yeah.
And sometimes not doing and making mistakes, and that's where
Yeah.
you learn your best stuff.
Yeah.
What's the best advice you've been given over the years?
I don't know. I've been given heaps of advice. I've got to say, I don't think I've got anything one thing in particular. I think for me, what I'm really good at is listening, and listening without a preconceived view. And again, something that I've tried to instill in the leadership team, well, what we call our coaches. We don't have managers in the business. I hate that word. I think it's a corporate bullshit
Yep.
word. So, what I instill with the coaches is to create a playing field for the team to come to that's level, open, fair, and encouraging in terms of the team bringing ideas, insight, difficulties, challenges to the table. And I guess that idea was given to me through one of my mentors. And as a leader, you think you have to kind of take control and have an opinion and maybe force that opinion on the organization. But that's a mistake. I think the best leaders, and certainly my leadership style, is suited to creating that playing field that brings the team to the field, that allows them to be vulnerable and challenge decisions that we're making. And I mean, I'll give you an anecdotal story. We hired a guy into a senior role, and he'd come out of the corporate world and still had that sort of mindset.
Yeah.
We're slowly breaking it down, and successfully he's doing a great job. But in a couple of weeks after he joined us, one of our junior guys said to him, "Mate, we don't do that around here. We don't talk like that around here." Like, which is his boss, right? So,
Yeah. Right. Yeah. Yeah.
the fact that we've got that culture in the
Yeah.
organization, and culture we haven't talked about yet, but culture is, so important for us
Yeah.
and a big part of our success. But having that open culture that allows a relatively junior person in the business to challenge not only his boss, but to challenge the founders of the business, to say, hang on, I'm calling you out on that. I'm
Yeah.
calling you out on that behavior even, is immensely rewarding, as a
Yeah.
business owner and as a leader of the organization, to see that culture, see those behaviors embedded, and see the values being lived
That's a
is,
really big deal, right? That's to see that, just that one story tells you so many parts of the story in terms of your culture. The fact that the young guy was confident enough to do it. The fact that your culture is so embedded in the business that he was able to pick that up. But then, but he was safe enough to be able to go and say it without fear or favor or anything like that. It tells you a lot.
Yeah. And then that particular manager, he was gracious enough to say, "Yep,
Right. Yeah.
and he pivoted, right? So, and culture's a hard thing, right? It's a hard thing to define even, but the one thing we're really good at is listening. And I think, to have a good culture, you got to listen to your people. Like, the reality is you can have a view. There's nothing wrong with having a view as a leadership team, as a shareholder group, whatever, but you have to listen to your team. And if you're not listening to them, you're stupid, because the reality is, if you want to hire 10 Domenic Lo Surdos and you haven't got a business, right? You got to hire different people, get different perspective, listen to them, and make changes off the back of those insights, those learnings, those challenges that your people put to you. And part of the great culture that we've got, and we measure it, right? We have engagement surveys which we undertake every 6 months or so, and then we act on them. And notwithstanding, our last engagement survey was like 99 out of 100. So our team love working at Stamford, but there's always something. There's always something that you can improve and get better at. And in fact, we sort of went through this process with an organisation called Great Place to Work. I don't know if you've heard of them, but
no.
There, it's a cultural engagement survey that you conduct, and then they basically rank you in your sort of category. And we ranked the 6 best business in Australia to work at. So, that was a huge honour on top of some great accolades that we've won from an industry perspective, to get that cultural engagement recognition, and the fact that we've got a team that loves working here as much as they do. That's, I got to say, setting aside the financial stuff, like, that's the best thing. I think seeing our team succeed, having them become the best versions of themselves, growing, learning. We invested an enormous amount in giving back to our people, and we just tend not to lose people, which is probably reflective of the culture that we've got, and also we have no problem hiring people either. I think it's something that's really insightful about that. People smart enough nowadays to understand and to look through that sort of corporate veil and go on social media and might be connected with us as a business. In fact, often the people we hire are referred to us by our existing staff, existing team. Probably 70% of the people we hire come through that channel, which tells you two things, right? It means the people that are working here love it, and the person that we hire, they're not going to hire them. They're not going to recommend them.
Yeah, absolutely.
Unless they feel like they're going to fit culturally and that they're going to be a huge value add to the organization. So, and one of our principles, coming back to the very first day of the business, was we want our people to be the best referral source of future talent. So, that's hugely rewarding to see that cultural piece being so rich in the organization, and the organization benefits from it enormously.
Yeah, right. As you've gone along and progressed as a leader, do you have any sort of mentors or business people that you look at as inspiring you, or that you've paid particular attention to?
I certainly have mentors, and certainly have people that I'll reach out to from time to time to ask questions. And I mean, I hope this doesn't sound offensive to people. I call them the grey hairs. So, guys that have been, or women that have been around more than 2 or 3 cycles, and have worked through issues, challenges, problems, and will put situations, scenarios, challenges to those people. I mean, tech is certainly a forum through which I get insight. I don't necessarily have an individual, I think, that I aspire to be or to become. I think, drawing upon some comments earlier, I just got to be true to myself.
Where you are,
and realizing that I think I can always learn. And again, coming back to that question of doubt, it instills in you this continuous process of acknowledging that you have to continuously learn.
And so, to that point, as you've progressed over the 12 years, what's what's next for the business? What's the next few years look like for Stamford Capital?
Yeah, listen, I think we're in a really good position. So we've built a terrific brand. We've got great people, great engagement from our people. We tend to hire really young and invest heavily in coaching, training, mentoring internally, both from a product and technical perspective, but also from a leadership and personal development perspective. The investments business, whilst we've done $600 million worth of deals, I think it's a sort of untapped gem for us.
Yeah.
We've got 4 super smart, great people running that business. It's completely scalable. And so we've just gone through a strategic review of that business. And I think we'll continue to invest in that business, in particular in this market where we think we're going to see great return premiums relative to risk appearing. And that's something that's pretty exciting. And we're having sort of early discussions with some investors around that.
Yeah. Oh, that's great. Dom, thanks very much for your time. On that note, we'll let you go. It's probably gone a little bit over time, but I really appreciate you being generous with your time and sharing your insights. It was fantastic.
No, thanks, Dion. Thanks for your time. And it's been a pleasure to be on the podcast. Good luck with it, hey?
Thanks very much.
Cheers, mate.
Thanks for listening to this episode. I hope you enjoyed the show. If you did, we would really appreciate it if you would leave a 5-star review and share with family and friends. Thanks.